Michael Carnevale is branch manager and financial advisor. Securities offered through Raymond James Financial Services Incorporated, 400 Southbridge Street in Auburn, Massachusetts, 1-800-657-9126. A member of FINRA SIPC and are not deposits, not insured by FDIC or any governmental agency, not guaranteed by Webster 5 Cent Savings Bank, and subject to risk, may lose value. Webster 5 Cent Savings Bank is not affiliated with Raymond James Financial Services Incorporated. The information contained in this report does not purport to be a complete description of the securities markets or developments referred to in the material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Any information is not a complete summary or statement of all available data necessary for making an investment decision and does not constitute a recommendation. Any opinions are those of Michael Carnevale and not necessarily those of RJFS or Raymond James. Expressions of opinion are as of this date and are subject to change without notice.
Good afternoon, ladies and gentlemen. This is the Long Hill Report, and we are fortunate to have Mike Carnevale of Raymond James to inform us of the direction of the economy this month, and we hope in a bit of the future too. So, we've had some interesting time. We just got through January.
We did. Historically, January is not a great month. Kind of ranks in the middle of the year, generally for stock market performance. And coming off a very strong December and last year, January Dow was down 3%. The other indexes were down more. S&P was down, I think, 6%, and the NASDAQ was 10 or 11. And so this is the second January in a row that's been negative. And of course, no one likes to see stock prices go down, the value of their account go down. But, if this year plays out like last year, we had a negative January 2021, and we ended up, plus 20%. So there's that old Wall Street saying, they call it the January barometer, that says, as January goes, so goes the year. Works out most of the time, but as we just saw the past 2 years, well, last year it didn't work out, and we hope it doesn't work out this year. Interest rates went up. When I mean interest rates, the 30-year Treasury back over 2%, right. But still nothing dramatic. And coming off a 20% yearly gain last year, I don't think losing 3-5%, no one likes it, but it's not the end of the world.
No, so it was kind of a, well, you say it's the middle, it's the sixth best of the year, so it's going to type then.
Correct.
Okay, so we don't have to jump out the window.
We don't have to jump out of any windows.
Okay. There's nothing year on year we should take, say like, if we have 2 years basically the same, a little down.
Well, we're in a midterm election year.
Yes.
So historically, those aren't the best years. Of the 4-year presidential cycle, the worst of the year is the second year, the midterm election. So we're all excited about last year's 20% gain. What these things say is that, well, that's another signal, right? Maybe we're not going to do as well this year. So if we don't do as well this year, there's no reason to get overly concerned, because historically, midterm election years are not the strongest.
Everybody's waiting for the shoe to drop.
For something to happen, right, exactly.
Okay, well, we do have the technicals.
Right, and we like to look at those because, one of the ways to, everybody talks about the long-term returns in the stock market, but the only way you can get those is if you stay in it for the long term. And so how do you stay in it the long term with all these things happening, breaking news items and whatnot? Well, you have to look at something that is sort of non-emotional, and that's technical indicators, because technical indicators basically are just mathematical formulas that can predict what might happen in the very short term. And so We ended last year near all-time highs for the stock market. We just saw that January was down, so we would expect, well, the technical indicators probably have weakened. And they have, right? The 200-day New York Stock Exchange moving average, a month ago, 45% of the stocks were above their average price for the past year. Today, it's 35%. That's better, right? Because
There's some room to go.
correct,
Up.
correct. We look at the volatility index. We want to see that number high. A month ago it was at 17. Today it's at 28. Anything over 25 historically says there's a lot of fear in the market. So why do you want to see that number high? Because history shows the public is always wrong. So the public, when does the public buy? After it's gone up. Prices go up because they feel good. When do they sell? After their prices have gone down. This volatility index measures that. So you want to see a lot of fear. We got that now. Or we have it more than we had a month ago. Then we look at the third one. We look at, and there's an unlimited, well, not an unlimited, but there's a lot of these technical indicators. I usually look at only these three because they can give you a quick snapshot. We look at the stochastic oscillator, which shows the recent price movement between a low point and a high point, a support price, meaning on the low side, and a resistance price, which would be the high side, over a given time period. You choose whatever time period you want to track it. I like to track monthly to coincide with these other two indicators. So between a 28% and an 80% is considered fair value. A month ago, we were at 76. Well, you remember a month ago, the stock market was an all-time high.
Yes.
This indicator picked that up by saying, yeah, it's pretty almost fair value, top of fair value. We had a decline in January, and we see the index today at the indicator today at 38%, closer to the bottom of fair value rather than the higher point of fair value. So if you look at these three things here, these three indicators, you can come to the conclusion that, yeah, the market's dropped 3, 4, 5% in January. Odds are that it's not going to drop another 3, 4, 5. That we're closer to a bottom today than we have been in the past month.
So, reason for some optimism. Anyway.
Correct. Correct. Reason for some optimism.
Now, we're going to talk what has been in the news quite a bit, and that would be the interest rates.
Right. So we all know, because we've all heard that interest rates are going up. Well, in January, the Federal Reserve met, and they decided not to raise interest rates, which wasn't much of a surprise, because it was only about a 1 or 2% chance based on another formula we follow, which is the federal funds futures market. They next meet in March. The odds of a rate increase in March are right now 62%. So what does that tell us? Yeah, we're getting closer to seeing the Fed raise interest rates. The only other central bank that met in January was Canada, and they followed us by also doing nothing.
Well, we're not going to. We discussed this a little before we went on the air.
Mm-hmm.
So we're not going to put you too much in the hot seat, but is it going to happen?
I think it is going to. Yeah. I think, they keep hinting and hinting the need to raise interest rates to slow down the economy, which will slow down inflation. Recently, they're talking about, well, maybe instead of raising it 1/4 point, which is the normal movement, maybe we might have to raise it 1/2 point. So immediately you say, well, that's really bad. It might be, but it also might be they're tossing that out to sort of talk the economy slowing down without having to do anything.
We discussed this before. This would say to people, if they're mentioning 1/2,
Right.
It's happening. Or if it is, we got to think about that.
Right.
So, but a half a point is a big jump for them.
Yeah, I mean, they've done it in the past, just not that often.
Do you think that would ripples among the opinion makers that we'd see a big sell-off? Or?
I think that would scare a lot of people, at least short term. And whereas they haven't done anything with rates since early 2020, it would seem odd that they would immediately jump in and raise them a half a point. They may go with the quarter and keep that out there, saying, things, if inflation doesn't come down or things don't slow down, we may at some point again have to raise either another quarter or maybe 50 basis points. So,
do you think they will do it? Are they doing it this way? Does somebody in the Fed bureaucracy call up his reporter friend at the Journal or Barron's or Bloomberg and say, they're talking here about a half a point? Is that kind of just sort of how they get the scare tactic into the news?
well, actually, the way they do it is some of the regional Fed bank presidents give interviews. And we had a lot of them after the Fed meets, because they've got like a news embargo the week before.
Yeah.
So after the meeting, a lot of them go on the business shows and get interviewed. Some are more favorites than others. The Federal Reserve Bank of Boston has never been a favorite to get on TV.
Stuffy people, probably.
Right. It's usually Kansas City, San Francisco, St. Louis, Atlanta are the ones that seem to get all the interviews. And a couple of them over the past week or so have said, well, and we would even toy with the idea of raising them 0.5%. Well, and as you just said, that gets noticed.
Yeah.
And sometimes, the threat can do as much good as actually doing it.
Okay. Well, I mean, I've heard that. Because I've heard that rumor. I'm not building my new factory.
Right.
I just decided that right now.
Right. And they say, oh, beautiful. Well, what we said, it worked.
Yeah.
It's going to slow things down.
And see, that's how I'm going to get out. I'm going to call up somebody I'm not building my own factory. And
Right.
we'll work this magic.
Absolutely. So we had two stock news items this past month. One was Apple, previously known as Apple Computer. During the month of January, it became the world's first $3 trillion market cap stock. Now, the market cap is the price of the stock times the number of shares outstanding. And I always like to bring this up because when Apple came public in December of 1980, the state of Massachusetts wouldn't allow you to buy it on the initial offering.
Yep.
Because they said it was too risky and it was losing money. So if you lived in a state other than Massachusetts and you put $10,000 in and completely forgot it, it'd be worth $18 million today.
I got a question for you on that, because remember, Apple is the new kid on the block. It
Yep.
came up, the personal computer, brilliant stuff. And it should have eventually got slaughtered by the bigger boys.
Yep.
But it didn't. But it had some hard times. What was his name? Scully?
Yes.
Basically had a coup against Jobs.
Mm-hmm.
And the stock
Tanked.
I mean, it really went down lower. I don't want to make any of the analogies. That could be a little gross, but it was very, very low. And actually, that was probably even a better time to buy it than when it came out first.
Oh, it was.
And
Oh,
that's when
absolutely.
I didn't buy it. So,
Yeah.
I usually don't like to talk about that.
About that. Yeah. Well, I can see why. The interesting thing, but right, and then Jobs came back,
Yeah.
and the iPhone and the watch and everything else, the TV, whatever else, and reinvented itself essentially.
Yeah, an amazing comeback backstory.
But it's interesting. It's interesting that because we have a very active Secretary of State department in Massachusetts. And it's interesting that, oh, you can't do that, it's too risky. And this is probably the poster child for bad outcomes. There hasn't been anything worse than that.
Yes. Yeah.
On the flip side of that, now keep in mind Apple's $3 trillion. Ford Motor hit a market cap of $100 million, their highest ever in January. Ford's been around a lot longer than Apple, nowhere near the size. But but another company that's kind of reinvented themselves, pushing now electric vehicles.
I am going to ask a question about Ford. I won't ask that question about Apple, because $1 trillion, that is something. But $100 million for Ford. What do you think? Is there an inflation aspect to that?
Oh yeah. Oh, definitely. Sure.
And then to further beat that dead horse, you have the Federal Open Market Committee, slightly more hawkish, which we've just talked about.
Right, because every January they change the voting members. 4 leave and 4 new ones come on. There are some that have permanent seats. All the governors of the Fed have permanent voting, as does the Federal Reserve Bank of New York. But everybody else comes in and off. This was supposed to be the year Boston got a vote, but because we only have an interim Federal Reserve president, the vote went to Philadelphia.
We also had a kind of a questionable president of the Boston Fed.
Right.
But we won't trash anybody here.
No.
We're above that.
That's absolutely right. World events, there was one really world event, which happened in Italy, where they re-elected a president. And, someone says, well, Italy, well, is that important? Well, if you're Italian, it is.
Yes, really.
And I am. But besides that.
And we're happy to have the president of Italy with us today.
Right. Yeah. Besides that, it's important because it's a big country economically. In the Eurozone, it's the 3rd biggest economy. In the world, it's the 8th biggest. It's the world's 6th largest manufacturing country.
And people don't realize that.
Right.
Their manufacturing, and like ours, where, if you go along one of those roads, near 20, all the factories that no longer have a worker in them at all. Mm-hmm. Italy has kept its place
right.
As a manufacturer.
Right.
So it is a heavyweight.
It is.
And nobody realizes that.
Correct. And most important, probably, was a founding member of the European Union.
Yes.
And, if the country was to leave the EU, there's some talk that then quickly a second country would leave, and then it could all collapse. So they re-elected an individual who's 80 years old, who didn't want to be re-elected. But
well, the presidency is, Italy was a kingdom.
Right.
And the presidency is sort of like, in most European countries, they have a prime minister who's head of government.
Right.
And the president, head of state. Now, like
Correct.
in England, they still have the queen.
Right.
But her most important function is just to say, I'm here, wave like that.
Correct.
So,
and that's the same thing here. It's the prime minister who has all the power.
Right, and that's a very tough playing field, Prime Minister of Italy.
Right.
Premier of Italy.
The good thing is that the current individual in there, Mario Draghi, was the head of the Central Bank of Italy, and then he was the head of the European Central Bank. So,
assuming the head of the Italian Central Bank is always doing the right thing.
Assuming, right? Yeah. Lastly, oil hit $90 a barrel. Hadn't done that since 2014.
And that's a big inflation thing.
That's a big, that's one of the big inflation items. And lo and behold, drilling is booming. You're up to 610 drilling rigs in the country. and that's the highest in almost 2 years.
Which one should hope means supply
Right.
will overcome demand and we can see prices lower.
Right. Right.
Everybody cross your fingers out there.
Yep. OPEC also said they were going to increase production in March, but only to their stated amount, not anything more. So it hasn't brought oil prices down yet.
Well, Anthony Blinken and Joe Biden called me up and said,
Okay.
what do you think we should do? And I said, you know what we should do? We should bug one of the biggest producers of oil in the world.
Yeah.
And I said, you know what? We're going to try and start a war over Ukraine with them.
Mm-hmm.
So that might throw a
Yes.
wrench into...
Yeah, because Russia's not in OPEC, but it's what they call OPEC Plus. And
OPEC Plus, yeah. And if they said, they're not going to do that, but if they said, we're turning off every spigot, yeah.
It's not to their advantage to do that.
No, but it's not to our advantage to bug them, but what the
Correct. Correct.
All right, so inflation, we have some numbers.
We do. So inflation, everybody's talking about how bad inflation is, and good or bad, that's subjective, right? It's high, but it's actually coming down. December, consumer prices rose 0.5%. That was lower than November, and producer prices were up 0.2% in November, in December, and that was also lower than November. So yeah, the numbers are high, but they're slowly moving in the right direction.
Yeah, that's true. One life problem about inflation is, it moderates, but it never goes backwards, which would be deflation. It has its own horrors.
Right.
But, the cumulative effect of inflation is less ability of younger people to buy a house and things like that. So, when does that crash?
When does it affect the...
When do we all start grabbing the pitchforks?
If we ever got back to, the inflation that was there in the early 80s, that would really be negative, and that was like 10 to 15%.
Yeah, but it never went away.
Well,
I know I bought my house in the 80s.
Yeah, the rate of increase.
Yeah, the rate of increase, it goes down, but the cumulative inflation on inflation on inflation.
Yeah. As long as you can grow faster.
Can we? That's where we're going to...
Well, there's the question. There's the ultimate question. The number itself is meaningless. You have to compare it to something. If you're growing at 50% a year, 5% inflation is not a problem. If you're not growing at all, 5% inflation is going to be a problem. But what you don't want to see is, as you mentioned earlier, is deflation.
Right.
Because that will paralyze.
You would like to see it get to a level where it could stay, where growth for the common man with his salaries would get to the point where it kept pace.
Right. The Federal Reserve has a target inflation level of 2%.
Yes, they've had
Probably not realistic.
No. When have they ever met it?
Right. But again, that can give you an indication of how the economy's doing. There are 3 other economic indicators we like to look at during the year. A lot of those have to do with employment. One is leading economic indicators, basically 10 components, gives a snapshot of the economy. Stock market's one of them, but building permits are another, big ticket items, right? And that's what they call the recession indicator. If you have 3 negative monthly readings in a row, tends to signal the start of a recession. So when people say, we're headed to a recession, what do you base it on? Well, I got a feeling. Okay. Well, if you look at leading economic indicators, in December they were up 0.8%. That's the 20th straight monthly increase. So if we're going to have a recession, well, we haven't even had one negative month. So it's at least 3 months away, if not longer. 8 of those 10 components in December were positive, similar to what we saw in November. good news stops. Good news kind of stops there, though, because the two negative ones are two big ones. They're consumer expectations and the length of the factory work week.
Thanks, Mike.
Okay. There's always, for every positive, there's a flip side. And those two items, because although there's 10 components to leading economic indicators, they're all not weighted equally. Consumer expectations and the factory work week make up 42% of the index. And why does the government assign that number? It's because our economy is so heavily based on consumer spending.
Okay, let's get out there, people, and do our patriotic duty.
Keep spending.
Keep buying. Years ago, do you remember Victor Kayan?
Yeah.
I remember they did a 60-minute thing on him. And his comment about the consumer economy was, well, we got to make stuff in this country. We just can't sell each other insurance.
Right.
So that's the 70% of consumer is based on consumer spending. When do we all run out of money?
Again,
I put you in the spot. I'm sorry.
yeah, if you're earning more than your costs,
I got it, but who's selling the insurance and who's making the gadgets to change our lives?
China.
That's fraught. Can we make something?
Oh,
Well,
we can. Yeah, we can make stuff. We just can't get people to buy it so that we can make money. There are certain items that, certain items, just about every item says made in China. Why? Because if we tried to make it here, the cost would be so high based on wages and stuff
I understand
that nobody would buy it.
Yeah. Well, I just hope the poor Chinese workman can buy his house.
Well, that's a whole nother story.
All right, the jobless claims.
Okay, so jobless claims are important because that shows us, well, how many people have lost a job during the month. Last week, 260,000. What does that mean? It doesn't mean anything unless we don't compare it to something, right?
Yeah.
A year ago it was 836,000. So fewer people are losing their job this month in January than they did a year ago. Long-term unemployment, folks out of work for 26 weeks, but still getting benefits and still at least saying they're looking for work, 1.7 million. A year ago, 4.9 million. So the job market is doing pretty good.
Yeah.
Fewer people are losing their jobs, right? But that's only half the picture. It's great you didn't lose your job, or less people are losing their jobs. But how many people are getting jobs?
Great question. And what kind of jobs?
And that's shown in the employment report. So the month of November, the final week in January, 260,000 lost their jobs. The latest employment report doesn't come out until the first week in February, but in December we saw non-farm payrolls, obviously people not working on a farm, increased by 199,000. So history shows in order to keep the economy stable, you need at least 150,000 new monthly non-farm payroll jobs. You got it in December. Size of the labor force. That's important because history shows people only look for a job if they think they can find one or that they feel good about. Labor force grew by 168,000 people. It means 160,000 more people went out and applied for a job. That's another very good sign. Wages up 0.6%. That's still not keeping up with inflation. That's a negative. But unemployment fell, and the U6 unemployment is the one that a lot of people focus on more because that takes into account people who are working part-time but really want to work full-time. So what's the real unemployment rate? Well, it's not 3.9, and it's not the U6, which is 7.3. It's probably something higher than that. But it's closer to the U6 than it is to the official, so to speak, unemployment rate. So the economic stuff, what does that all tell us? Inflation appears to be slowly going down. Good. Leading economic indicators, again, positive. Good. Jobless claims, fewer and fewer people losing a job. Good. And the employment report, we created at least 150,000 new non-farm payroll jobs. So that's a plus for the economy. And the size of the labor force increased. Good. So if people are looking at, oh, things are really bad, the economy is really bad, can't tell it by these numbers.
Okay. Well, the vibe that you get probably is not people saying, putting the economy under a microscope. Cousin Fred lost his job.
Right. It's all personal.
Yeah. It's obvious.
Yeah. So we go into February, not a great month historically, but the positive, you usually see stock market bottoms in February. And that historically the next 5 months, meaning beginning in March, tend to be up. So there's reason to be optimistic.
And we are happy to hear that, because then when spring and summer,
Correct.
and that's happiness right here all the time anyway.
Absolutely.
So, Mike, thanks for keeping us on track, and we look forward to seeing you next month. Mike Carnevale, Raymond James, thank you.
Thank you.